Yahoo Finance's special breaking news coverage of the July Fed decision. I'm Josh Lipton here with my colleague, Julie Hyman. We are just moments away now from that July Fed decision, and stocks falling here. The Dow is off over 700 points as investors count down the minutes to this July decision, and tech earnings, of course, after the close. Julie, so after this Fed decision, your base case would be they stand pat, they hold steady, because you know what? That last inflation print, that was friendlier. And maybe it stays friendlier, that's the case. So what's the rush? But it is interesting the degree of uncertainty here, the number of questions being raised about maybe you do get a surprise here in just a few minutes. The economist Stephen Stanley, we know Stephen, smart guy. I like Stephen. He said it has been many years, he told his clients, since there has been this degree of uncertainty about whether the Fed would change policy or not in the lead up to a meeting.
There is an unusual amount of dispersion amongst the forecasts out there. Now, and the people I've been talking to, one person called it a hawkish hold, that he was expecting that you would get a hold, but maybe with a little bit more of a bias towards tightening. Somebody else called it what he characterized as a sloppy hold. That was how Christian Hoffman of Bloomberg called it. I love that in characterization, by the way. What he meant by a sloppy hold is that you could get some dissents amongst the committee, right? That you would get a hold, but like a hold that doesn't give us a lot more clarity on what's going to happen. The family fight, the good family fight that Kevin Warsh has been describing, that he would welcome, that is, sort of dissent and argument and debate amongst the members of the Fed. That is probably going to be in evidence as well. As to any clarity, like those who are saying, oh, well, once we get through this, maybe they'll telegraph what they're going to do in September. Like, have they met this guy, this new guy? I don't think there's going to be any telegraphing, but we'll see.
Now, I had folks on my show, it was interesting recently, who were like, you got to hike. You got to hike. You got to hike because you've been over target for 5+ years, man. And you can talk tough all you want. You got to back it up at some point with some action. To paraphrase Governor Waller, what did he say? He said, listen, just looking sternly at inflation, just looking at inflation with a disappointing gaze is actually not a game plan.
Okay, but what if the main reasons for the inflation are supply side reasons that the Fed can do nothing about? Are they going to look sternly at President Trump and tell him to stop the war with Iran so that we can get some relief on oil prices? They're not going to do that. So that muddies the waters considerably. It's not like there's a clean question here.
It's almost like I've had others on the show who say they sort of frame it like hiking is not only, there's an economic reason, but they also bring up it's also for credibility reasons. Like if you came out and did this, you would have convinced the public and the markets you actually are really serious about it. And maybe you would put to bed these questions we have about Warsh and Trump and the relationship.
You can make all those arguments. That doesn't mean they're going to do it.
No, it
right?
doesn't.
And you can also make the argument the other way, by the way, that even if you strip out the oil prices, which have been higher, that the underlying level of inflation is still higher than the Fed wants it to be. If you look at other things that have been putting pressure on PCE, things like the increasing prices for financial services, for example, that stuff is not seeing relief. And so if that's the case, then, what do you do on that side of the? There's just like too many arguments either way.
And how about the argument, which is a fair one, which is you have a lot more data between now and mid-September. You'll have like 2 full cycles of inflation figures. That's a whole lot of data. What's the rush would be the argument. Yeah. And to your point, though, I like what you said. As to the presser, what you get there will be, this is a guy, he plays it close to the vest. How much more color and commentary are you going to get?
Right. Maybe not a lot. The other, the last thing I would say is that it's not that the Fed is unimportant by any means. The Fed is still very important. But it feels like the Fed and oil prices generally have not been the engine that's been driving the market. It has been earnings.
Oh, 100%.
And so, until and unless the Fed does change 100%. Things, that would likely
I've had,
be the
I don't know
case.
on your show, but I had a strategist just yesterday. At least it relates to the stock market. First of all, it's interesting how I kind of have to push people even about the Fed, or it doesn't really come up. And this guy kind of said, I'm paraphrasing, but as it relates to the stock market, he kind of was like, Fed Schmed. It's really on earnings and AI. That's what it is.
Fed Schmed.
Yeah, well, it's no sloppy hold, but it's.
but Fed Schmed. Maybe these should all be banners below us. Fed Schmed, sloppy hold. I think we should just collect all of these.
Would you agree with Stephen Stanley in your time? You've been doing this for a while. That this is the most uncertainty you've seen in a while.
It's up there. It's up there. It's up there. And I think we could see the most dissents we've seen in a while, potentially as well.
All right, let's get to Jennifer Schonberger with that decision. Jen.
No change. The Federal Reserve holding rates steady in the range of 3.5% to 3.75%. But this was a split decision with 3 dissents. Lori Logan of the Dallas Fed, along with Cleveland Fed President Beth Hammack and Minneapolis Fed President Neil Kashkari, all dissented, preferring to raise rates by a 0.25 percentage point. Other than that, the policy statement was identical. Officials reaffirmed that inflation remains elevated on account of higher energy prices due to the conflict in the Middle East. They said, quote, the committee will deliver price stability. Back to you.
Wait, Jen, when's the last time we had an identical policy statement? Sorry to jump in here.
Yeah, it's been some time. You know, I was wondering whether they would rip it apart like they did last time and make it all fresh and new, but I guess things are the status quo. It'll be interesting to hear from Warsh the explanation for this decision. What was interesting to me, though, Julie, was that this really matched up with the comments that we had heard from individual members of the Fed leading up to this meeting. Lori Logan gave a hawkish speech saying that she thinks rates should be modestly higher right now. She dissented. Beth Hammack also basically making that point without saying, hey, I think we should hike. Neil Kashkari was a little bit of a surprise. He had said that he had penciled in a rate hike for this year, but I felt like he could go either way. So I thought for sure 2 dissents. The fact that we saw 3, let me tell you, it must have been a good family fight.
Yeah.
All right, stick around, Jay. We want to bring in some other voices now. But Julie, that decision, I mean, listen, what we were expecting, what's your immediate thoughts on that?
I mean, it's kind of, it's what we were expecting. We got the dissents, we got the hold. I don't think there's any big surprise here for the markets. That doesn't mean things won't move on this sort of, and that the market won't read this hawkishly. I think there was already in some quarters 100% chance of a hike in September being priced in. I don't know that 3 dissents changes that at all after this.
Would you suspect that because of this, does any feeling that press conference has to get a little bit more lively? You're going to get even more pressing. Maybe Warsh gives you something about how he sees the world, more Warsh's view on the economy, inflation. No,
I don't think so. He's going to say we're waiting to hear from the task forces, and that's going to take another few. I think that's not happening until the end of the year. So it doesn't feel like we're going to get a lot more from him today.
All right, let's get to Yahoo Finance's Jared Blickery now with the market reaction to all this. Jared, what do you see?
Yes, we're seeing a tiny bit of risk-on action. You can see the Dow is still in the red, but I'll pull up the intraday price action. So here is the reaction, just a little tick up off of that report. So losses being paired, still looking at 626 points to the downside. Nasdaq, a little bit bigger reaction, and in fact, it has broken into positive territory. You can see it's up a whopping 3 basis points or 4 points. S&P 500, a little less bad than it was just a few minutes ago before 2 p.m. And I also want to call out the S&P 500 equal weight index, which reached a record high yesterday, an intraday record high today. It's been doing better than the regular S&P 500 because it's not weighed down by those mega cap stocks. So we saw a little bit of a bigger upside reaction off of that. We'll also check it on small caps. And there you see they're still down a bit, but a nice little pop there. And usually we see the fireworks happen when the Fed chair takes the lectern or the podium at 2:30 p.m. Eastern. But we know Warsh is no fan of these press conferences. The last one was cut short, and it would be really interesting to see how this one plays out. Here, we're going to look at the bond market. These are Treasury note futures, and this is a 2-year tenor. Important to know that these futures move the opposite of rates. So we saw this tick up, and that means rates are going down, and that's probably a good thing, especially with respect to the 10-year. Not going up as much here, but that means longer-term rates taking a rate down, tick down there. We have seen the 30-year yield hold above 5% for most of this month. And that is a potential sticking point for stocks if it were to accelerate to 5.2, 5.3%, but has not done that. So let's check in on a couple more markets and we'll get to some heat maps on stocks. Here are gold futures. They turned positive, up about 2/3 of 1%. You can see they were negative in the red for most of the day there. And we can see a similar reaction in silver, which is up 2 points or 2% to 58.68. And also checking out out Bitcoin. I was a little bit surprised to see that we had a nice reaction to the upside off of Bitcoin, which is up 1%. Sometimes Bitcoin reacts to these big economic reports and FOMC decisions. Sometimes it does not. And today is one of the times when it's ticking to the upside. Now, here is a look at our large cap sectors. And you can see energy, it's been in the top spot all day long, up more than 1.5%. And then we got communication services. That's where you see Alphabet. That's where you see Meta. And then consumer discretionary also up about 0.5%. That's where you see Amazon and Tesla. And then we also have consumer staples. That's the stuff that you need as opposed to the stuff that you want. And that is up about 0.4%. What is not working today? Industrials. They are down 2%, utilities down 1%, and then you also have financials, materials, and tech, each off about 0.75% to all the way up to almost 1% there. But let's take a look at the Nasdaq 100 heat map, and some of those dark red squares, guess what? That is the chip sector, once again, trading to the downside. If you follow the stocks, that big chip index, that's about 10,500 right now. We'll take a look at that in a second. But I want to point out some of the bigger names. Apple, which is going to be reporting after the bell tomorrow, that's up over 1%. That's probably a record high or close to it. Alphabet also up 1.7%. And then two big earnings after the bell. We got Microsoft and Meta, each of those up under 1% as well. If we take a look at the semiconductors, this is what I was referring to a minute ago. Not as bad, not as ugly as we saw yesterday and some of the prior days, but it's just been a really bad run since they topped on June 22nd, about 25, 26 trading days ago. And I talked about the stocks before. Let's take a look at that index. It is down 2%. It was down all the way below 10,500 or about there. At the lows, it is now 10,800. Here's the year-to-date chart. You can see it was up almost to 15,000. So that is a big, big decline, more than 25%, approaching 30% right now. So that's something we'll keep in mind as well. Here's the software complex, much more green here, and that is a welcome sight. We've seen rotation into software from chip stocks quite a bit lately. But bringing it back to the main point, the Fed decision, we've seen bond yields moving in the right direction, which is a little bit to the downside. We've seen stocks moving a little bit up to the upside, but really it's going to depend on what Warsh says in about 23 minutes here, guys.
All right, thank you, Jared. Well, for more on the path for interest rates and the Fed's read on the economy, let's welcome in now Citi economist Veronica Clark, along with JP Morgan Asset Management Global Market Strategist Mira Pandit, and our very own Jennifer Schonberger is still with us, joining in on the conversation as well. Veronica, as the economist, I think we'll start with you. That seems right. Statement's pretty short here, Veronica. It does repeat the line, committee will deliver price stability. What do you make of it? Is this what you told your clients to expect?
Yeah. We were expecting them to do nothing today. Very much nothing. We got no changes in the statement, apparently. I think that's the right move. I think we should believe, of course, that they're going to achieve 2% inflation. But I think we at least learned that Fed officials are still trusting the data, right? Because there was a hawkish element of the June meeting, but everything that we've learned since June should tell you that you should maybe wait here and see what we get. And I think the next couple months of inflation data will look pretty favorable for them. I think we can have core CPI.
Why do you say that, Veronica?
Yeah, I think we can have core CPI that gets to something like 2.2, 2.3% year on year. There's some pretty big base effects. We saw the broad-based softness in the June data. You'll still have the issue of core PCE, which of course they target, being above 3. But that might not be the case for much longer. We're going to get some big revisions to core PCE in September. So I think it's at least reason to question the signals of core PCE and look at these other inflation measures, and CPI I think will be pretty close to where we were in 2019.
So does that sounds like you don't think they necessarily need to move at all?
Yeah, I don't think they are. I don't think they're going to be hiking this year. Yeah. We'll be talking about cuts again at some point.
Mira, is that your view? Dovetail with the JP Morgan view?
Essentially, we thought that there would be no move this meeting as CPI was a bit softer. And to Veronica's point, broad-based when you look at some of those different core measures around services and core goods. So I think that is an important step forward when it comes to inflation. The question is, how impatient is this committee growing with a persistent overshoot from an inflationary standpoint over the long run, and how much pressure are they feeling around that? It's also interesting that every meeting is a live meeting when you don't have forward guidance, and all of a sudden the dissents start to become a little bit more of a forward guidance mechanism. So I certainly think that markets may be pricing in more hikes when we think about the remaining meetings for the year, given some of these dissents, and to see how that maybe builds. But from an economic perspective, if they can get to the end of the year and we continue to see that energy piece soften, they may see a multiple sources of disinflation next year between shelter, between services when we think about softer wages, and even relative to goods when we think about a slightly lower overall tariff environment than we were on average last year.
Jen, I want to bring you back into this because if you've got a Fed chair here who keeps saying price stability, price stability, price stability, and then as the folks on the panel are saying, there is value in being patient and letting that price stability sort of be achieved on its own. But isn't there a credibility risk if he keeps hammering those words?
I think it's going to depend on the data. And to both of the other guests' points, we did see that drop in core CPI inflation. And it wasn't just a small drop, it was a large drop. So it could have been confusing to markets if they had said, nope, we're hiking. We would have thought, okay, well, what are you seeing about inflation that we're not seeing right now? The fact that they held doesn't mean right now that Warsh has a credibility issue. However, if inflation starts heading back north over the next couple of months through the summer and we get to September, and then he's not doing something about it, then I think the credibility question mark comes into play. But right now, remember, he needs to make sure that he's not confusing markets and that even since he's not giving forward guidance, that reaction function of what their path is going to be, how they're going to respond, makes sense and is clear in that vacuum. To the extent they would have hiked today, that could have confused markets. And remember, Warsh wants to take signal from asset prices right now. And if those asset prices are confused, he's not going to get the right signal.
Veronica, we can talk about different inflationary pressures, and obviously we talk about oil. What about AI and the great AI build-out? How near-term inflationary is that?
Yeah, I mean, you certainly see it in pockets of the inflation data. You know, computer software and accessories, that's been a really big reason why core PCE is stronger. It's a tiny component, but it's been worth about 20% of the increase in core PCE the last 6 months or so. That is one component that's getting revised in September, though, so it might not look quite as strong in a couple months. But yeah, you do see the pressures on computer prices and whatnot. But you're not, getting that broad-based, spillover, right? If computer prices are rising, you're really not seeing it in services or things like that. And the types of inflationary pressures that would matter for services and for, prices broadly, wage pressures, home, house prices, things like that, you're not seeing the inflation there.
Mira, is it possible that we could get this revision of CPI methodology and then get another one? Because after the task forces do their work, right? If they decide they then want to look at things, isn't that what one of the task forces is working on, right?
Yeah, data quality.
Yeah.
Look, I think that they'll want to look at a breadth of data, which the Fed already is looking at, and maybe they start to tweak the way that they're looking at things in particular. But ultimately, the data is the data. You look at the CPI numbers, you look at the PCE numbers. It's hard to revise away 5 years of that experience for consumers as well from an inflationary standpoint. And it's hard to revise away or think about different methodologies around inflation expectations. And that is a concern long-term for them if things do get de-anchored in some way. We haven't necessarily seen that in a major way this year. You've seen some fits and starts, but nothing too out of control. But there is just such a broad spectrum of different measures that they're already looking for. So I do wonder that maybe there'll be some critiques out of the task force there. But if they change the way that they're looking at data massively, is that maybe a bit of a credibility issue as well?
Jen, just to bring you back here, I'm curious to get your thoughts about what you expect from this presser. There are folks, Jen, who, certainly they're hoping we get a little bit more out of Warsh, a little bit more color and commentary, lifts the curtain a little bit more, gives us a little bit more about his view of the world, his view of the economy and inflation. Our friend, the economist Joe Bruce-Wallace, puts it like this. He says, Warsh has avoided answering tough questions in his first few public appearances for the sake of his and the Fed's credibility. One would expect that approach will end at the Fed policy meeting. What do you think, Jen?
I think it is getting harder. I think that Joe makes a good point. And on the point of credibility, I think he's still going to stick to, I'm not going to give forward guidance, but he's going to need to explain today's decision. And he's going to need to take a step further than saying we're going to deliver price stability. I don't think that that's going to cut it at this point. He's going to need to give more color on, okay, if we see that inflation is moving in the wrong direction, we're going to act. Something to that effect. He can't just brush it off like he has for the first 2 months of his chairmanship. And as for, how much more color we'll get today, gosh, I hope he can share with us what his assessment of the economy is right now, because that's technically not giving forward guidance, right? It's not saying here's what I think will happen and what we will do in response. I also hope he can share some scenarios that perhaps folks within the FOMC meeting kicked around, because that is what we saw laid out during the minutes, right? They looked through different scenarios. So was that the pale through which they looked at the scenario, at the situation today? That's something that I would like some insight into.
Mira, I want to ask you about bond yields here, because we've seen them move higher on this perception that even if the Fed wasn't going to tighten today, that they were going to tighten at some point this year. How do you think about then the sort of achievement, the tightening that achieves without the Fed having to do anything?
It is a piece of that, when we think about broader financial conditions, but ultimately I do think yields, especially when you look at the 10-year, are accurately reflecting the fact that we still have very solid economic growth, likely on pace for 2% for the year. That is in line with long-term averages. We do still have that persistent inflation, so there's a little bit of stickiness there that warrants yields at this level. So I don't necessarily think that there's a mispricing when we look at the belly of the curve there and where yields are based on what the economic data is. So I don't think that should also change their reaction function too much. It's not signaling a massive tightening in financial conditions that would warrant tightening in and of itself. I don't think that that's necessarily what's going to do it on this inflation overshoot. And what they have to think about too when it comes to a rate hiking environment is if we genuinely do move to a conversation more around rate hikes, and you look at the most recent dot plot, it almost implies that there's going to be one insurance hike. Within the hiking camp, is it an insurance hike? If you're actually experiencing this persistent inflation overshoot, does that warrant 2 or 3 hikes? So even as the committee members discuss the hiking conversation, there's a lot of nuance to that as well.
Veronica, so the JP Morgan view, solid economic growth, does that dovetail with your view?
Yeah, more or less. I think we probably are running growth that's around 2%, and maybe half of that is consumption driven and half of it is AI investment. But it is interesting. We're going to get GDP data tomorrow. We had data for Q4 and Q1 that on average was actually a bit below 2%, and it looks like tomorrow might be also. The Atlanta Fed GDP now is tracking at 1.5% right now. So that's 3 quarters where growth is maybe running a bit below potential, and very exposed to the AI story. So I do think that's not necessarily, that's a maybe fragile place to be.
Yeah, and the markets are very exposed to the AI story, obviously, as we've been seeing over the past several days, and are much more keyed into that than to the Fed, especially if the Fed is holding. Mira, how are you thinking about the AI trade right now? We've been talking a lot on the morning shows about, is this just sort of a blip or a speed bump? Is this the start of more fundamental questions starting to be asked? How are you thinking about it?
I think the good news is we haven't seen this broad-based collapse in the AI trade. I've been characterizing it as one of stagnation and rotation. Some of the early winners around software and the hyperscalers, the Mag 7, are not doing so well this year. But you look at areas like semis, despite recent volatility, that are still holding on to 30% gains for the year. If you look at just the S&P component of semis, you look at power, hardware, same thing. So you're seeing different areas of that trade flex. I think the one reaction function we have to think about as we see more earnings come through is we want to see CapEx continue to grow, but we want to see revenues grow by more. And when it comes to the hyperscalers, and there is a bit of investor fatigue in terms of how much these stocks are being rewarded. You're not just seeing that among the Mag 7 hyperscaler set, but you're increasingly seeing it in the semis as well. So we have to think about that dichotomy between robust results and what's already in the price.
Yeah, 2 more big names after the bell today, Microsoft and Meta, so we'll see. Yes. Jennifer, thank you. And Veronica, Mira, don't go anywhere. We'll continue this Fed conversation after we hear from Warsh. Coming up, much more Fed coverage on the other side of the break. Fed has left interest rates unchanged, with three FOMC members, Hammett, Kashkari, and Logan, dissenting in favor of a rate hike. Let's get more analysis now from Mark Zandi, Moody's Analytics chief economist. Mark, it is great to see you as always. So we got the decision, Mark. What do you make of the decision? Is it the decision Governor Zandi would have voted for?
Well, thanks for that, Josh. I think I would have done the same thing. No change. You know, what struck me though was the statement. If I'm reading this right, the statement this time was exactly the same as it was, 4, 5, 6 weeks ago when they met last time. They changed the date maybe, but other than that, no change. And I don't recall ever that happening in all the decades I've been watching the Fed. Maybe it's happened. I'm getting older. But I don't remember that happening. And that probably is testimonial to the way the Warsh Fed's going to be run. I just think they're going to be very parsimonious with what information that they provide. And we really got no information as to how they're thinking about, what's going to happen or where they're headed, or even more importantly, what their so-called reaction function is. What is it that they're looking at to help make a decision about future monetary policy?
Mark, it's Julie here. You are not imagining. They indeed did not change. And
Was it? Okay.
I think parsimonious Warsh is going to stick. I really like that, actually.
Good SAT word, yeah.
Yes, as a moniker for him. So what, in your mind, what did change between the last meeting and this meeting? I mean, as you said, you wouldn't have changed rates, but we've had oil come down, but then it went up again, right? So has the picture significantly changed?
No, I guess that it helps explain why the statement didn't
maybe.
change. I think oil prices are going up, they're going down, they're going all around. Depends on events in the Middle East, and that's just all over the map. So we're still sitting, what are we, $85, $90 a barrel? So that really hasn't changed all that much. Underlying inflation feels like it's moderating a bit. We'll have to see, get a few more data points, but it feels like it's moving in the right direction. And you've got some gravitational pulls on inflation, most notably around cost of housing. I guess one thing to notice, I think very important, inflation expectations, at least as measured by the bond market, they're well anchored. I mean, I was just looking at 5-year, 10-year break evens, and they're rock solid, right exactly where you expect them to be. So that's all good and suggests that the Fed doesn't need to raise interest rates. And then you look at the economy, it's kind of the 2% economy. We got 2% growth last year. We got roughly 2% in the first quarter, my tracking estimate. And I've seen a range of estimates, but they're all centered around 2. So yeah, you make a good point. I mean, nothing really has changed all that much in the economic environment in the last 4, 5, 6 weeks.
Mark, just to get your take, the case for a hike on my show from folks kind of went like this broadly. It was like, listen, the Fed has missed its target for 5+ years, and tough talk is great, but at some point you got to back it up with action. And they would also make the point, Mark, it's a credibility issue. If you had hiked, it would convince the public and the markets you're actually serious about this. It would have ended kind of hot talk you get about Warsh being beholden to Trump. What do you make of those arguments?
Well, it would be counter to kind of monetary policy 101. I mean, monetary policy 101 says if you get hit by a supply side shock, Russia invades Ukraine, oil prices go skyward, Iran war, tariffs, these are, presumably one-off inflationary shocks, except if they affect inflation expectations. If inflation expectations start to rise, then you got a problem and you got to respond to that. But as we just discussed, that's not the case, and expectations remain, rock solid, well anchored, no problem there. So that would all argue that, yes, we're unlucky. We got nailed by a bunch of stuff, some of it out of our control, some of it in our control, but it shouldn't ultimately lead to persistently high inflation. And then here's the other thing to consider, that it just feels like to me people overly discount. The economy is soft. I mean, we're growing 2%, but that's not enough to create any kind of jobs. I mean, job growth is morbid. I mean, the only sector of the economy adding anything to payrolls in any meaningful, consistent way is the healthcare sector. Everything else is, kind of flat on its back or losing jobs. Yes, the unemployment rate is low, but participation rates have fallen very sharply. In fact, if the labor force participation rate had remained unchanged over the past year, the unemployment rate would be over 5%. And we'd be talking very differently about that. And you can see the slack in the labor market developing through wage growth. Wage growth is definitively slowing consistently and now is below what you would expect given productivity growth and those inflation expectations. So, why raise the rates and kind of undermine the economy when everything else says, just stick to script? I mean, yes, you got to be disciplined because we're getting nailed by one shock after the other. But, unless it affects inflation expectations, I think we stay on hold.
Mark, I'm curious, since we're in the midst of earnings season, that's very much on my mind. How do you square your view of sort of lackluster economic growth with the just absolutely blockbuster earnings that we've been getting?
Oh, well, a couple things. I mean, obviously, and you probably know the data better than I, but, it's obviously a lot of the growth is in the earnings growth is in the tech companies, AI-related companies that are generating a lot of earnings growth and expectations for a lot of earnings growth. Outside of that, earnings growth it's pretty good, but it's more pedestrian. It's not inconsistent with an economy that's growing 2% nominal with the kind of inflation rates that we're getting. So that's a reason I think to kind of discount that argument. The other is that the profit share of GDP of national income is rising. It's at a record high. Businesses have a lot of pricing power, and they're not passing through any costs that they have to shoulder. They're passing it right through to consumers, and labor is shouldering the burden. So to some degree, it's who's getting the benefits of the pie. The pie isn't growing all that quickly, but the businesses are getting a larger share of that pie, and that helps explain the better earnings.
Speaking of earnings, Mark, you got two big names after the bell. That's Meta and Microsoft, another read into our great AI trade. Do you agree with Warsh, Mark, that ultimately AI, yes, it boosts productivity and does act as a disinflationary force?
I think the operative word, Josh, was ultimately. I think that's the key. I mean, like right here and now, and for the foreseeable future, meaning into next year, probably through the remainder of next year, is that AI is inflationary, right? Because it's juicing up demand, through the CapEx, but also more significantly through the wealth effects.
Hey, Mark, my friend, I got to interrupt you there. Great to see you as always, but we got Fed Chair Kevin Warsh at the podium.
FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. Two economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows 4-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on 4 questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Thank you for taking our questions, Mr. Chairman. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman. And I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers like market pros can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly. But the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterize the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much, not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead, but I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. Suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate. Inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision-making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a 3-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. but I wouldn't say it's in isolation. I tried to describe in my remarks today a point that I made into the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. But we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months, we're going to refine that view and have a better judgment. And we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big, hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause. They reacted to the inflation data in one direction, strong economic growth in the other direction. And nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods, but they matter more. What are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, because I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple of weeks, I'm going to be doing a check back in. I've given them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Temeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either-or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order, but really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in and around AI, it's making that calculation a little harder to judge. But in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, When do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us, they weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon-feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period, what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we're saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions, and if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast, we don't want your dot, we just want your reaction function. Part of me hears what we really want is your forecast, and what we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode, we were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all of that information, so I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is going to help us make better decisions, and in so doing, satisfy our remit.
Thank you. When you talk about the 2% inflation target, what measure are you relying on?
Yeah, so I'll give two answers. First, let me give the proper standard answer. The Federal Reserve every January outlines a statement of purposes and strategy. And in that strategy document, which I believe was dated January of this year, it describes a measure of PCE inflation as the objective function there. I have enough of my own, so that's our number. We're sticking with it. Who knows, come after next January, what we might say about strategy. I suspect the task forces might have something to add. But I'll say this, some version of the Lucas critique, some version of Goodhart's law in economics should remind us that when we talk about measures of inflation or something else, and we describe those measures as being consistent with our objectives, we might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more. But to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago, I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that, even though the remit is quite narrow.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you've said today, and maybe you can help clarify this. You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates, but all you've talked about today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah. So believe it or not, this press conference is not all I've done today. We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, evaluating our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty? So the decision we'd made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it. But I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced. And over the coming months, I expect it to be advanced much more significantly. If I were to steal a follow-up question, I won't let you won't be giving it up. If I were to steal a follow-up question, well, what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks. But we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting was an important step towards that destination.
I'd like to follow up on the task forces as well and ask, what vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, How can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is we're the decision makers. The chairman of the board of the Federal Reserve and the members of the board and the FOMC, we will be the consumers of the outputs from 5 different committees. The judgments we're making will be informed by, but not at all determined by, these outside groups. My theory of the case in establishing the task forces were to pick people with extraordinary talent, depth of expertise, and a divergence of views inside every committee, so they too can have a family fight. This is not outsourcing to people that aren't known and haven't been vetted. This is seeing whether new ideas can catalyze a broader, better, more informed discussion inside the room. And I'm very confident that we're going to be able to do that. I am impressed by the credentials of these 15 people. And full disclosure, I've known almost all of them for a very long time. And I think they're going to give their best views on the subject. But ultimately, these are decisions we're going to make, and we're accountable to our oversight committees and to the remit Congress gave us to deliver.
Hi, Anne Saphir with Reuters. Nice to see you again. So I need a little help here too. You've said repeatedly you have no tolerance for inflation, and yet we are seeing above target inflation repeatedly for 5 years and through your term so far. And sure, you have no magic wand, but you have not taken action. You just gave us a little peek at your reaction function as well. You said that if underlying inflation is rising, that you would tend to think that you might need to tighten. And with the exception of the most recent inflation print, that is what we've been seeing. So could you explain what you mean by no tolerance for inflation and what you plan to do about it?
Sure. So, Anne, I hear from you what I hear more broadly from households and businesses: impatience. Deliver it already. This is not an excuse. This is a fact. This FOMC, this board has been in business for 8.5 weeks. The patience, the impatience that households and businesses feel have been going on for 63 months. We are on the job. We will deliver. We are focused like a laser on making sure we can do it. But the suggestion that we're going to be able to do it with our magic wand is one I want to disabuse you and everyone else of. But the discussion in the last 2 days give me more confidence even than I had 8.5 weeks ago. This team that we have at the FOMC, the support that we have from board staff, and the new hard questions we're asking, we need to resolve those. And as we resolve those questions, get smarter on those, we're going to deliver on the remit. You don't have to take my word for it. If you look broadly at market prices, they are certainly not saying all clear, but they are working in concert to keep us on our toes. And they have tightened financial conditions in this intra-meeting period. And that has given us, that has provided us some comfort that we've got the ability and capability to deliver.
And is your read or your, I guess, faith in markets' ability to sort of make a judgment and then you to take signal from that judgment, how does that affect you when you come up on the September meeting and markets are seeing a near 100% chance of a rate hike as they see now? How does that feed into your decision making and your thinking?
So we're not going to be constrained by market prices. We're not going to be constrained or take verbatim from what the market's doing. But I think it's useful and to understand that markets can be a very good source of information, not a determinative source, not a perfect source. But if we're trying to land the plane and deliver 2% inflation, and we take a very useful source of information and we get it all fogged up by giving it our own forecasts, by providing rolling commentary, I can assure you that we're going to have less information, less ability to land the plane successfully and deliver price stability. We're just trying to make sure that that source of information is as direct and unfiltered as possible. It isn't to the exclusion of data sources and opinions and other surveys. But if you're hearing from me, we wanted to make sure we were getting a better source of information. I think in a relatively short time we are.
We'll go to Brian Chung for the last question.
Hi, Chairman Warsh. Brian Chung with NBC News. So you said you'd be open to having press conferences when there's news to make. So today, no change to rates, no forward guidance. For the average household, I guess, what was the news today?
So apparently it was news that I had a press conference. Let me just see if I can offer some clarity on that. Between now and year end, my predecessors and the Federal Reserve committed to press conferences this year. I'm committing to press conferences this year. That might be news to the people in this room and of no particular interest to your viewers and your readers back at home. What I can offer as assurance is that the Fed's on the case, that this Fed chairman feels better about this board and this committee's ability to deliver than I did when I showed up here on the first day. And I showed up pretty confident. I've been heartened by the reception that I received. No doubt in some of your commentaries today, you'll talk about a divided Federal Reserve. Well, that's not the feeling I felt the last couple of days and the couple of days before it. What I felt was a group of professionals, all with different perspectives, different views, different judgments, but eager to roll up their sleeves and have a family fight, and eager to reform the way in which the Fed does policy, a keenness and open-mindedness and curiosity about that, so we have a far better chance to deliver on the remit that Congress gave us. And so I want to leave you with the optimism of a new central banker that we're committed as ever to deliver and to offer an assurance we will. Thank you all very much.
Back in now, Citi's Veronica Clark, along with JP Morgan Asset Management's Mira Pandit for more on what we just heard. All right, Veronica, so here were some highlights for me. Washington sounding hawkish, right? Continues to talk tough on inflation. Talking tough, Veronica. There is no soft inflation target. He says there is no soft implicit target, not on this committee's watch. He says the Fed will not waver, making it clear inflation is not where they want it. I thought it was also interesting, emphasizing that now, he says, market participants, he says, they're learning to play the ball, Veronica, not the referee. The Fed does not want to interfere with market signals. Comforted that markets were reacting to real events, not Fed guidance. Markets can be a very good source of information. What were some of your highlights?
Yeah, it is interesting. He's talking the tough game on inflation, of course, and he seems to like the implicit tightening that markets have delivered over this intermeeting period. We have rates that are higher, market yields that are higher. Yeah, I don't know if there's really a whole lot to take away, right? He's really not giving us a whole lot of guidance.
There was some hope for that, Rob. For some of your colleagues, other very smart economists, I was reading their previews, they were kind of hoping like, all right, I hope I get, he kind of lifts the curtain, I get a little color and color. I get more sense of like Warsh's view of the world.
Yeah, he tried to give us some more of that maybe, right? The Fed is trying to get at what is true underlying inflation, looking at a range of measures. So I think that is something interesting that we learned. But yeah, certainly in terms of policy rates, he's not going to give us any guidance. I do hope at some point we do hear more about how he and other officials are actually thinking about the specifics of recent data, right? Tell us what other inflation measures are you looking at other than core PCE?
Well, on that point, that was interesting, right? Because he was talking about it. He he looks more broadly than PCE. Yet, yes, he cares about PCE. He cares about CPI. But my lens is broader than that. That was an interesting comment.
It is, and I think it's fair, right? If you look at across the range of inflation measures, the way that we would measure underlying inflation, it is very much core PCE that has the issue. That is the outlier. Most of these other measures are, they're not at 2% yet. They're not at levels consistent with 2, but they're really not that far. They're only a couple tenths higher than where we were in 2019. Hopefully we get some more specifics there at some point.
Mira, bring you in here because you look through a different lens, right? As a market strategist, what were some of your big takeaways?
Maybe I'm one of those people he was describing as not being able to let go of forward guidance, but was the whole thing forward guidance between the dissents, the talk about not being data dependent and not paying attention to that one soft CPI reading, and also the constant use of this word inertial, anything but inertial, that does signal that they are thinking about movement ahead. And yet I contrast this very much with data dependency, which feels very real time to me, reacting to what the data is telling us, with what I perceive to be the reaction function is these 4 questions, these long-term strategic, meaty projects with the combination of the task force. Those are not going to be conclusions that we're going to come to that quickly. And again, these are not things that have not been thought about for years by a number of other Fed officials on the board. So my question is now the reaction function actually a much longer term dynamic here that actually forestalls those rate hikes despite some of that overture around hawkishness and wanting to move forward on their inflation target and that impatience?
Veronica, what if they don't raise rates, right? But they just concentrate on adjusting their balance sheet strategy? What impact could that have on inflation?
Yeah, it is interesting, and that might be a focus at some point. I don't think it's anything that we hear about anytime soon, right? There's a task force for that too. So we have to maybe wait and see what the task force comes up with. But yeah, Warsh has had a history of maybe trying to be a bit more hawkish on the balance sheet. He sees it as maybe, addressing some of those more market, driven inflation measures or whatnot. Maybe that can tighten financial conditions a bit, and rates are more broad, for the broader economy. But I don't think we'll hear anything anytime soon.
We're about to hear from big tech after the bell, Veronica, Microsoft and Meta. I asked Mark Zandi this, but I'm curious to get your take. Warsh believes obviously AI, it boosts productivity. It ultimately acts as a disinflationary force. Is that your view?
I don't know yet, right? Yeah. We're really not in that phase of the more widespread adoption where we're seeing obvious signs of productivity in the macro data at least. I think we're still very much in that build out phase, and so you wouldn't really expect to see that yet. It might be deflationary at some point, but I think Fed officials and probably Warsh included would want to see that in the data before they react to that disinflationary force.
Mira, get your take on that because you got Microsoft and Meta today. You got Apple and Amazon tomorrow. What's at stake for the broader market with these reports?
I'll respond also and add on to the point about whether AI is inflationary or not. It almost doesn't matter in the context that they've laid out of this 5-year overshoot because it hasn't been at play that much over the totality of the last 5 years, being as nascent as it is. So I think to continue to lean on that again is getting back to those big meaty questions that perhaps don't have relevance to the current inflation overshoot that we're seeing. And in terms of the mega cap tech reporting, this divergence between the economy and the markets. The economy is not the market is not the economy. Tech is a very small share of jobs. It's a very small share of economic growth typically. The AI capex notwithstanding, providing a little bit of a boost there. But it's going to be a huge part of earnings because essentially you have 50% of S&P 500 earnings growth expected to come from 3 semis. So there are so much concentration around this tech story, even as the AI theme broadens out, that's such a swing factor for how earnings play out and therefore how markets react. Again, I don't think the reaction function is as handsomely rewarding to profitability as it was a few years ago.
Do you still stay overweight large cap tech here?
Look, it's a big part of this AI theme in terms of where the trade goes, because as the trade has rotated, a lot of that still does live within large cap tech. So we need to be a little bit cautious around wanting to avoid it wholesale, but rather be nimble around a much more differentiated landscape of winners and losers.
All right, Veronica and Mira, that was a great chat. Thank you both. Appreciate it.
Thanks.
Well, for more on Fed Chair Kevin Warsh's presser, we have Esther George, former Federal Reserve Bank of Kansas City President and CEO. Esther, it is always great to see you. Let's just start with the decision, Esther. It was the base case, they would stand pat, but boy, Esther, there was a lot of questions and a lot of uncertainty about whether there would be a surprise. But what do you make of the decision, Esther?
Well, it was the decision I expected. It wasn't 100% chance, as you know, but it seemed based on Chairman Warsh's testimony to Congress that he was going to be patient. And I take the last inflation report as sort of giving some cover to taking it slow on reacting to the inflation they have.
Esther, one question, though, that came up in that presser from at least two reporters is Warsh was grilled a little bit on, if you've been over your target for 5+ years and you've made it clear, Warsh, that you're worried about inflation, you don't like where we're at, you're concerned about it, and the labor market is stable, why not raise rates now? What's the answer to that, Esther?
Well, his answer to that was the markets are doing that work for the Fed right now, that since the last meeting, the yield curve has steepened, and it is giving him a signal of saying, how are the markets interpreting how the economy is doing? The other thing I heard, Josh, was that they will continue to talk to the markets in terms of reaffirming their commitment as a way to anchor inflation expectations. And so between market and yields being up, continuing to reinforce a message, sounds like they are using those as primary ways of buying time rather than simply moving an interest rate to try to address the inflation they've seen.
Esther, what about those who've said, you should hike because it's not just an economic question, it's a credibility question, and that if you hiked, it would convince the public and markets that you are in fact serious about it. It's not just talk, there's action to back it up, and that's important. What's your response to that?
I think that's very important. We know that the words central bankers use are very important, but I think it is also clear from the research that actions speak louder than words. So you can get away for some time with talking about commitment, talking about your resolve to get back there, but eventually it does come down to action. And the question, I think, for this committee is how patient should they be at a time when inflation has persisted above its target as long as it has? So that's, I think, going to be the key question. And what I heard is we may be waiting to see the outcome of the task force work before we can really get a better sense of what their intentions are.
Esther, what if you don't raise rates but you adjust the balance sheet strategy? What impact could that have on inflation?
Well, it could have some impact, but I think its primary impact would be to unsettle the Treasury market. So that portfolio has been there a while. They are slowly letting that roll off. And so I don't see that as being a primary tool or necessarily a very effective tool at trying to address demand outstripping supply in the economy. That really comes down to their nominal interest rate instrument.
Esther, there was also a lot of questions about the dissents. I'm just, take me inside the FOMC. I'm just very curious. How animated, Esther, are those debates and discussions? Is it contentious, Esther?
Well, it can be contentious, and I think particularly at times when you are beginning to see stronger feelings about what the direction should be. Now, this is a committee that for some time, some of its members have been very clear about their concern about inflation. And you also know inside the committee, there can be others, they're either not voters or maybe they're not inclined to dissent when they have some of those same views. So the dissents really give you a signal of what some of the arguments are. That you had 3 dissents at this meeting, I think is significant in terms of an ongoing conversation this committee has had with not only those who dissented, but I think others about the concern of tolerating persistent inflation over their target. And I think that's an important message coming out of this meeting.
Another topic, Esther, at the presser, interested to get your take on this, with the task forces, right? And Warsh clearly, listen, he's made it clear he wants smart people revisiting and reconsidering how things are done at our central bank. If you were still at the Fed, Esther, would you be a fan of these task forces?
Well, I'd be very much supportive of the idea that the central bank is really obligated to revisit its strategies, to think about how its models of the economy work. So I'd be very open to this work. Where this group comes out, though, remains to be seen. And so we heard Chairman Warsh say today that he's going to be checking in with this group in the next couple of weeks, certainly before he goes to Jackson Hole, to try to get a sense of where they're focused and what they'll be looking at. But the truth is, I don't think we're going to know much about the outcome of this task force until we actually see not only their reports at the point they become public, but the decisions of this committee on what exactly they believe they need to change.
And finally, Esther, I thought it was interesting, Warsh at the presser talking about the data he's looking at, and he said he's looking more broadly than PCE. Yes, of course, emphasizing cares about PCE, cares about CPI, but he says, my lens is broader than that. What did you make of that?
Well, I think that's always been the case. When I sat on the FOMC, my lens was broader than PCE because there's certain contracts and prices that build off the CPI. There are other ways to slice the data that try to give you a sense of momentum. So when we talk about trimmed mean measures, those are useful. Looking at private sector information is always a good way to try to either confirm the data you're relying on or the measure you're relying on and look for contradicting signals. So I'll be interested what exactly might come out of this task force that suggests there is a different metric to base their decisions on. But looking broadly, I think has always been a hallmark of the FOMC.
Esther, as always, great to have you on the show. Thank you.
Thank you.
Let's get some more reaction out of today's interest rate decision and Fed Chair Kevin Warsh's comments. Yahoo Finance Jennifer Schonberger joins us now. Jen.
Hey there, Josh. It really struck me how much attention Warsh paid to the yield curve and the fact that nominal Treasury yields are much higher than they were at the Fed's last meeting. And he seemed to take comfort in that. Nobody got to get into question of, okay, you're examining strategies for price inflation and monetary policy, and yes, the primary instrument is the interest rate. However, he says they're also looking at the balance sheet. I wonder if they're also looking at the bond market to do their work for them. He noted that this is early stages of the policy. This is that there's a path that they are going to be taking. This is not a pause. Take a listen to what he said when he got several versions of questions of why he wasn't hiking rates today.
So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time.
He also said when necessary and appropriate, the Fed is not going to hesitate to act. When asked whether it was that lower core CPI inflation that sort of caused the outcome of today's decision, he said no, basically we're looking at trends. And he also gave us a glimpse into the fact that he personally is not looking solely at core PCE inflation or CPI, but he's looking at a larger range of indicators. We also got a little bit of insight from him on the state of the economy. He characterized it as, quote, solid. He said CapEx is strong, productivity is strong, and he says that's what the Treasury market is signaling. So you kind of wonder, okay, is the Treasury market doing your work for you and saying you need to raise rates, or is the Treasury market reflecting, and maybe it's an also, that the economy is strong? Josh?
You know, Jen, reading through the economist notes heading into the meeting, there was some hope among those very smart men and women that, you know what, maybe it will get some more color and commentary from Warsh today. Maybe he kind of lifts the curtain. We'll come away with a better sense of just how our new Fed head views the world. Do you feel like you got that, Jen?
No, I don't think we did, Josh. I mean, maybe a little bit more of a breadcrumb or two, but I think there's still a lot shrouded in secrecy, and I think there are a lot of folks hoping for more. He kept coming back to the bond market and not answering those key questions on rates. I understand he doesn't want to give forward guidance, but I think at times there was perhaps some confusion as to, okay, well, what does this answer really mean? And so I think that markets are going to be wanting more going forward. It'll be interesting to hear what he does at Jackson Hole and if this trend continues, or if he decides post Jackson Hole in the fall to give more information. Certainly if they decide to start hiking rates, I think he's got to give a little bit more there.
All right, Jen, thank you as always. Appreciate it. Coming up, we're looking ahead to the other big headline for markets today, tech earnings. That's next on Market Domination. To get even busier with earnings from Microsoft and Meta after the close. For more, I want to bring it out. Yahoo Finance tech editor Dan Howard. Dan.
Yeah, we got a kind of murderer's row of earnings lined up here, and I'm definitely not going to get much sleep tonight. Obviously, the big.
Luckily, tomorrow's commerce, so you have that to look forward to.
Yeah.
Not much going on.
No Apple, no nothing like that. I think one of the things to keep in mind here is that this is all going to kind of be, I think, part of this referendum on the AI spending. We saw a reaction from the street when Google said that they were going to up their spending. Microsoft has taken a big hit over the past few months just on its spending.
Down like 20% this year.
Yes, Microsoft not doing so hot. And so, this is going to be, I think, a kind of look at, okay, Microsoft, if they increase spending, what does that mean? Meta, if they increase spending, what does that mean? Qualcomm is more of a look at how is their data center business doing? What is AI doing to the smartphone market? This is all kind of interlaced, and it makes my job kind of fun. So with Microsoft, we're expecting earnings per share, let me just pull this up real quick, of $4.25 on revenue of $87.7 billion. That would be ahead of the $3.65 they saw and the $76.4 billion they saw in revenue in Q4 last year. This is their fiscal Q4, despite the fact that we're nowhere near Q4 2026. The big numbers, obviously, to watch out for are intelligent cloud. That is expected to come in at $38.1 billion. It would be a 12% increase, and remaining performance obligations. Those are basically contracts that Microsoft has signed, hasn't yet delivered on, but that's the revenue that they will eventually bring in. Last quarter, that's expected to grow this quarter to $647.6 billion with a B. So, little more than $500 billion of contracts that they have here. That would be up 72%. Obviously, the CapEx, as I said, is going to be a major part of this conversation. Microsoft has repeatedly stressed that they are capacity constrained, means they just don't have the computing to meet demand. And so there's been discussions of, did they not spend correctly? Were they too late to spending? They were back and forth with OpenAI. OpenAI didn't like the way Microsoft was spending. They wanted more capacity. Microsoft said, let's not get, too out over our skis. Let's, kind of take it easy. Now it seems as though they're trying to catch up with that. We'll have to see what that means for spending overall. But it's obviously not just them. It's also Meta. They've been spending like crazy. They've been taking it on the chin as a result of that. They're one of the worst performing stocks of the Magnificent Seven year to date outside of Microsoft. And they may announce a new data center business. So we've seen, Mark Zuckerberg teasing this during previous earnings calls. He brought it up at Investor Day, and then he spoke to Bloomberg and said, yeah, sure, we're looking into that. Why not start selling some of our chips or releasing our chips out to third parties, the Googles of the world, whether they're our biggest competitors, I don't know. The Anthropics, SpaceX has done this already. They have a deal with Google. They have a deal with Anthropic. They're going to bring in billions of dollars as a result of that. What if we can monetize this stuff now for an inflated price? Because right now everybody's trying to get as much compute as possible. They can really kind of drag some folks over the coals here, get a good amount of money out of them, and then maybe, end those leases and put them to work for themselves. We'll see how that works out. They're also they also recently announced their Muse Spark 1.1. That's their latest model, as well as the kind of pricing that they're going to be offering for access to that application programming interface. Basically, what they're going to charge folks to be able to use the model. Their method is to go undercut everyone. So they're dramatically undercutting Anthropic, dramatically undercutting OpenAI when it comes to the matching level of model that they have to offer. The thinking there is, well, if we can get everyone to like what we're offering, we'll have them locked in. They'll keep coming back for more, and then maybe we can just start amping up the pricing down the line.
What did you make, Dan, of this media blitz that Zuck is on? By the way, I mean, he tells talking to New York Times, blasts the centralization of AI power, so supporting more openness. He's clearly going after OpenAI, going after Anthropic. What did you make of that?
I think it's so originally they were open model, and then they're proprietary model with some open model offerings. OpenAI has its open models as well. I think the broader thinking here is, well, OpenAI and Anthropic clearly are dominating. You know, so's Google. That's a advantage that they may never be able to catch. And so if you kind of say, okay, let's say that we should have more open models. We shouldn't have these closed models or rely on these closed models. Let's bring in more open models. It makes those proprietary models that are more expensive less appealing. Now, on the security front, there's an argument why this makes sense, right? The more open models, the more people have access to them, the more they're able to test them and do security checks on them. And then, hey, we have very secure AI models. That's the way that open source software works as well. You're also able to, if you want, download these models and run them on their own. But it's not like you can download this and run it on like your Windows PC or your Mac. You need gigantic server farms and things like that. So it's not as though it's I'll be able to run a model, you'll be able to run a model, and we'll all have free models. That's not how this works. But he has been going on this blitz. He did an op-ed, I think, with the Wall Street Journal.
Yep.
Yeah, basically saying that we need this because it'll help provide intelligence for all, or super intelligence, or
and kind of
clearly
going after Anthropic, talking about, hey, well, if you think this is going to wreck the economy and the labor force, what are you building it for?
Well, and that's also a comment that I think has become more prevalent. And I think it also speaks to kind of the populist movement with regards to data centers, right? So people, the big thing with AI when it came out was, we're all losing our jobs. That's all that's going to happen. Jobs going to go poof. You went to school for software engineering, or you took a software engineering boot camp. You thought it was, your ticket. Guess what?
Code, not so much.
Yeah, no. Right. Get out of here. Tell an AI how to code. And it's been, kind of a mixed bag, right? It doesn't seem as though it's been this apocalyptic, kind of layoff, but it also has impacted certain jobs. And so, I think that rhetoric and the kind of response to it from folks has been, well, these things are using up all this energy. They're going up next to my, my neighborhood, and they're going to take my jobs. Well, why do I want this anymore? And so if you notice, we've seen this kind of almost 180 on the rhetoric around jobs and AI more broadly. And now it's, hey, it's not going to take your job. Just so you know, it's going to make you more productive, and there might be more jobs as a result of that, because companies are going to want to hire more people because they'll be more productive, they can bring in more revenue, see more sales, it'll be great. So it's very interesting to see this kind of just complete flip on what this means for jobs. And I think, Zuckerberg in that op-ed was kind of speaking to that to a degree with the, why are you even building this if you think it's the most dangerous thing on the face of the earth? It's also, by the way, I was speaking to a cybersecurity expert about, the OpenAI Hugging Face hack, and his response to that was kind of, well, it's also a way to talk up your own company's capabilities. So if you say this can create bioweapons, hack everything on the planet, and do your job for you, it makes it seem like it's the greatest thing on the planet and it's super intelligent. I should invest in this, right? I got to get it on the ground floor. And so that's kind of also what's going on here. A little bit of showmanship, a little bit of gamesmanship. So it's just interesting to see this. And I mean, we'll have to see what the results are for Microsoft, because the big question still is, what's the ROI on this? When do companies really start cashing in?
Show me the money.
Exactly.
Show me the money. We'll find out after the close. Dan, thank you. Appreciate it, buddy. We're in for another big earnings day Thursday with Apple releasing its latest results. Yahoo Finance's Jared Blickery joins now with some Apple options plays he's been watching. Jared.
Thank you. Apple is heading into earnings after notching 3 straight record highs. So what can an investor do if they already own the stock, want to stay in it, but are not sure Apple has a huge move left? One possibility is a covered call. That means you own at least 100 shares of Apple and you sell one call option against those shares. The call option gives someone else the right to buy your stock at a set price. The upside is simple. You collect money up front, called the premium. The downside is also simple. If Apple keeps running up, you may have to sell that share at a set price. Now, in this example I'm going to give you, Apple is near $340 a share right now, and you sell an August 21st strike price. That's where the price of the shares could be sold, and you collect about $4.35 per share, or $435 total. All that money is paid up front. The option lasts until August 21st, and after that, it expires. Now, check out this chart right here, which shows you how much profit or loss you can make with the option itself. Along the bottom, you see numbers where those refer to Apple's stock price and where it ends up on expiration date. The numbers on the left, all the way over there, they go from negative 8,000 up to 2,000. That's the profit or loss on the option. And notice the green arrow area on the left that I'm circling here. If Apple finishes below $355, the option expires worthless, and the seller keeps that full $435 premium. But once Apple moves to about $355, notice how the line starts falling here. Why? Because a call seller has promised to sell Apple at $355, even if the stock itself keeps climbing higher. That is unlimited loss potentially. So by itself, that option can look pretty ugly. But guess what? By itself, it would be. This investor also happens to own $100 shares, and this is the key. So if you own those shares that gain value as the stock rises, well, then that offsets the money you would have lost from the call. So let's go to those owned shares plus the call option in one single chart. The white line here shows the result from owning Apple alone. Every $1 in the stock changes the value of 100 shares by about $100. The green line shows the full covered call. Notice the small gap between the two lines. That is the $435 profit, which gives the covered call a little bit of a head start. It lowers the break-even price from $340 to about $335.65. But this is only a cushion. It is really not crash protection. Now look at what happens if Apple is at $355 on expiration day. That's this level, that vertical level right there. The green line goes flat. No more profit no matter how high Apple trades. And that's the trade-off. The covered call reaches a maximum profit of about $1,935, while the stock by itself can keep climbing. So if Apple knocks earnings out of the park, this may turn out to be a poor trade. The investor keeps the premium, but gives up everything above $355. So a covered call actually works best when the stock rises just a little bit, it trades sideways, or it slips modestly. You get paid today, but in return, you get to put a ceiling on tomorrow. Back to you, Josh.
All right, thank you, Jared. Coming up, we're checking in on some of today's top trending tickers. That's next on Market Domination. Take a look now at today's trending stories with Yahoo Finance's Brooke DePalma. We're going to start here with DoorDash. Brooke, why are we starting with DoorDash? Well, because they're building their own delivery drones.
Yeah.
Apparently got a nod from the FAA for commercial service. They plan to launch their own drone deliveries in the fall. What do you make of this, and why are they doing this? Is this speed? Is it profits? What do you think?
So it's certainly both of those. And they did say that they're not going to essentially eliminate that delivery worker that exists right now, but they're also looking to perhaps compete with Uber. And this might be a good plug in there. If you could see, I mean, year to date, this stock is under pressure. It's down nearly 15%. And over the past year, I have Alpha Space up right now. You can see right there, down 15%. Over the past year, this stock down 22%. And so really the company is looking for different catalysts to get more and more consumers inclined. Of course, this does come with some challenges, Josh. I mean, you can't necessarily have this sort of delivery service where there's tall city buildings and so on.
And
so
which is why they say, listen, humans are in control for right now. Your drone, you can't really navigate, an apartment building.
Just yet.
Yet. Fair point. All right, topic 2. Nextera is teaming up with Brookfield, described here as a $100 billion transformation, I guess, of this shuttered uranium facility in Kentucky into a data center campus. I see Energy Secretary Chris Wright saying the U.S. government is leveraging its assets like our federal lands to add power generation, create jobs, and ensure the United States wins the AI race.
Yeah, and I thought what was really interesting about this report was where exactly this campus is going to be built. It's actually going to be built on a pre-existing spot for the Department of Energy. It was constructed in the 1950s to produce enriched uranium, essentially for nuclear weapons, and then it was later, then changed to nuclear reactors. It was closed in 2013. And why I bring this point up is because this is a critical point of the upcoming midterm elections. We know that these data centers have gotten a lot of pushback among voters, and essentially by building it on this current facility, or rather this closed facility, it'll use what's already existing, the pre-existing water capacity, fiber, other infrastructure that already is built. And also, let's keep in mind, this is the Trump administration's ratepayer protection pledge. This kind of goes along with it. But as you can see, this stock is also outperforming this year. The stock is up about 23%. Once again, looking at Alpha Space, seeing that stat there. And so it'll be interesting to see how this plays out just in terms of these energy companies and how they're able to take advantage of these sort of opportunities here.
All right, finally, Cheesecake Factory reporting. That looked like a strong quarter, right? Increased customer traffic, comparable sales rose 5.8%. Is this about value? Is it about the menu, marketing? All three.
Value, menu, marketing. I mean, is this like the triple threat or what? We've seen Cheesecake absolutely soar. This stock up 100%. I mean, he's not excited as I am. I mean, this is insane. 100% year to date. I'm looking at Alpha Space yet again. And in the past year, the stock's up more than 50%, obviously outpacing so many others, especially those that we're expected to hear today, including Chipotle and Starbucks. This company has really been leaning into menu innovation, also social media marketing that's helping it garner a younger audience. They're engaging with them more. That's according to their earnings call. And so obviously, everything that they're doing right now, especially in this environment where consumers are picking and choosing where they're going to spend their money, it seems to be working though for Cheesecake.
My wife took the 7-year-old to Cheesecake Factory, and she was blown away by just like the size of the menu. Like she said,
and they added more.
If you can imagine it, they will make it.
Yes.
It's wild.
Yes, they have bowls and all that.
Yeah, they plan to open up, by the way, up to 26 restaurants this fiscal year. So they're looking to keep that momentum going.
Absolutely, Josh. Yeah.
All right, thank you, Brooke. Coming up, we have you covered through the closing bell on Wall Street. Don't go anywhere. Seriously, Maureen. Stocks ending the day lower here with the Dow leading that decline. Yahoo Finance's Jared Blickry joins here with the latest. Jared.
Pretty red tape in the final hour, some ominous things happening. Let's break it down. We got the Dow down quadruple digits, 1,152 points, or just over 2%. Not a huge move, but this is what's concerning me, and we're going to get to the bond market in a second. That's where the real action is. But let's take a look at the Nasdaq. You can see it briefly turned positive after the report was released, that statement, that decision at 2 p.m., and then throughout the presser, well, it was all negative. Similar chart for the S&P 500. Down 1.5% at the end of the day. And let's go to, let me cover this. This is a VIX, and we saw that punch above 20. Not a huge development, but that is a level above 20, kind of a big level that catches attention. Now, here's a 10-year yield. It was up 2 basis points to 4.62%, and here's the 30-year at 5.14. Now, the bond market closed at 3 p.m., so this is not reflecting what happened in after hours trading for the bond market, but I can tell you right now it is trading at 5.19%. That is the highest level since 2007, and that is a bit concerning because with rapidly rising long-term interest rates, that can really spook institutional money, and we can see stocks sell off, and that might be what's happening, what was happening in that final hour. So let's take a look at the large cap sector. At the end of the day, we saw energy up 1.85%, staples up modestly, but here's industrials down 3%. That was the biggest loser, followed by tech down 2.5%, followed by financials down 1.5%. Those three sectors were the only underperformers from the S&P 500. Here's the Nasdaq 100, where we see there's NVIDIA down 3.5%, SpaceX down 3%, and the semiconductors are their own animal. We'll get to those in a second, but I'll also point out that Amazon down almost 2%, Meta, which is going to report almost right now, down 1%, and Microsoft also reporting now down about 0.7%. Here's the semiconductor board, and I've been covering this ad nauseum every day. Let me just get the final SOX level for you because we got to be approaching down 30% from those highs that we saw on June 22nd. 10,000, about 10,450 there. 10,000 is kind of a big level, but suffice to say, semiconductors not in free fall. We've seen mostly orderly selling, but it is a bit concerning the span that they've covered in a short period of time. So here's software, where we see actually quite a bit of green outside of some of these larger numbers or larger stocks. And here's the equal weighted view, and you can see Intuit up 6%, Adobe up 5%, Datadog also up 5%. So some nice gains in software. Shows you market rotation, sector rotation still in effect. That is good news. Here's the Dow, and aside from the mega caps that we were looking at, JP Morgan down 3.5%, Goldman Sachs down 5%, Boeing down 3%. So we saw financials and industrials, two of those three that were underperforming the S&P 500 today. Well, you can see that reflected in Caterpillar too, down 7%. So my concern all along has been, so far we've seen semiconductors really take the brunt of selling. We've seen sector rotation kind of do its thing, and we haven't seen a market-wide disruption just yet. But with long-term yields punching above those yearly highs to 2007 levels, well, you better pay attention tomorrow. Back to you, Josh.
All right, Jared, thank you. For a deeper dive now in today's market action, we have Kelly Kowalski, MassMutual Head of Investment Strategy. All right, Kelly, let's just pick up where Jared left off there. Fed comes in, they stand pat. War steps up, sounds hawkish, right? Not happy with where inflation is at. But what do we make of the reaction of financial markets? Got red all over the place, stock market's down, yields are climbing. What do you think?
It's really interesting, Josh, because the consensus expectation going in today was for a hawkish hold. And that's exactly what we got. But if you really look at the press conference and you were tracking the probability of a September hike, it started to decline as Chair Warsh kept talking. Mm-hmm. And it leads me to believe that perhaps the bond market is more concerned that the Fed doesn't hike than if it does. Mm-hmm. Because there is this, we talk about credibility, we talk about inflation expectations. And it's, in my view, it's part of the reason why the 30-year Treasury yield is at its highest level since 2007.
There was some calls, Kelly, by some smart folks going into this meeting. I'm interested to get your take on this, that they should have hiked, not just for economic reasons, but for the credibility issues you're talking about, that, so the argument when you can only talk tough so long, at some point you got to back it up. It's sort of like Governor Waller, I'm paraphrasing, mm-hmm. but he says, just looking, very sternly at inflation with a kind of a frown and a look of disappointment. That's not actually a strategy. You got to act at some point. Do you think that part of what could be going on here?
I think that is part of it, and it's really interesting because if you go back to Warsh's first press conference, he said that he wants for the Fed to listen to the markets, not for the markets to listen to the Fed. And what you have is the markets have pricing in 2-ish hikes over the next several months, and markets are saying, Fed, are you listening to us? We think you should tighten conditions. And maybe some things he said in that press conference alluded to the fact that they may not hike come September. Maybe the support isn't there beyond those 3 dissents. And the bond market's getting a little uncomfortable, and maybe it's doing the tightening for the Fed.
How much do you think, if at all, what we're seeing today could also be what we're seeing in oil? Geopolitical risk and uncertainty renewed again. You saw Iran and Trump exchanging headlines there. I have Brent back above 90. What do you think?
It's really interesting. The oil picture is certainly complicating things for the Fed. We can talk about, whether to hike into supply shocks or not. But what we have seen over the past several days is actually a decoupling in the price of oil and inflation expectations. Market-based measures of inflation expectations have remained relatively tame, even though oil pressures have gone up. So one must ask why. Is it because the market believes it's temporary? Is it because the market believes that the Fed will hike and temper inflation to some degree? Well, what we saw again after the press conference or during the press conference was inflation expectations start to creep up. So you have both inflation expectations rising and then real rates rising, and that's leading to your pressure in bond markets.
Okay, so after seeing and hearing from the Fed today, and you're seeing the reaction of the financial markets, does it impact or change in any way where you see risk and reward in the stock market?
I don't think so. I think that you're going to have headwinds from higher long-term yields. It is hard for markets to really rally and post strong returns when you have yields moving 10 basis points a day, right? It's going to be a headwind.
So yield risk is a problem.
It is. But I don't think it sort of changes the secular themes, the fundamental drivers you have in the equity markets with AI, and also sort of this broadening out trade beyond AI. Investors, they want diversification. They want to stay invested. It's kind of the message that we're seeing from this rotation within U.S. equity markets.
Listen, you got Microsoft and Meta today. You got Apple and Amazon tomorrow. The big question, Kelly, has been, okay, big tech is spending to build out their AI dreams, and there seems to be greater pushback now from investors saying, show me the money. Where's the return? Do you get that question from your clients?
That's the million-dollar question with AI what is the return on AI? It's a hard one because we don't know, and our answer is that we are really in the early innings of this. Most people are using AI in a generative way. You use it as a chat bot, you get your answer. But there are applications that I don't think a lot of people have really envisioned, or that most people aren't using AI in that way when you think about agentic AI, when you go to robotics. So we really embrace taking that long-term view. We see the demand for compute. We see token consumption, rising exponentially. So the demand tailwinds are there. Are we going to get an ROI number that we love on Microsoft and Meta's quarterly earnings? Probably not, but it's really focusing on sort of the long-term secular story.
Over the next 12 months, Ken, I'm just curious, what do you think some of the biggest risks or mistakes investors could be making in the equity market?
I think one of the risks is obviously concentration risk, and I think you're seeing that play out a little bit in debt markets where, several months ago when we saw Meta bring their first data center, we didn't imagine the amount of issuance we would be seeing over the next few months, and that's what you're seeing unfold, is that investors are pushing back because they're saying, whoa, this is too much supply, I need to demand a higher risk premium for lending you this money. So I think being patient is very important part of this trade. And then also diversification, right? AI is one part of the market. There's the AI spenders, there's the AI receivers, but don't forget about the AI applications. There is a whole universe of companies that are going to benefit from AI application, like financials, like healthcare, and maybe that's part of the reason we're seeing strength in those sectors today.
Kelly, great to see you today, especially on set. Thank you.
Thank you.
Time now for a look at Meta as its second quarter results just hitting the wire. Inez Ferre joins here with those numbers. Inez.
Yeah, Josh, just taking a look at its second quarter revenue, Meta's revenue came in line with expectations. It sees third quarter revenue at 61 billion to 64 billion. The estimate was for 63. Its second quarter revenue, as I mentioned, in line, and its second quarter earnings per share came in at $6.18 versus $7.14 year over year. Now, here's the important stuff. Meta said that it anticipates its 2026 capital expenditures to be in the range of $130 to $145 billion. That's narrowed from its prior outlook of $125 to $145 billion. Also, the company saying that it's continuing to monitor active legal and regulatory matters that could significantly impact their business and financial results. They're saying that they continue to see scrutiny on youth-related issues in several markets and have a number of youth-related trials scheduled for this year, which ultimately may result in a material loss. So their outlook includes $2.4 billion in charges related to legal proceedings. And you're seeing the stock down in after hours, Josh.
All right. Thank you, Inez. Appreciate it. Microsoft reporting fourth quarter earnings just moments ago. Let's get you those numbers. Q4 EPS 474 versus consensus at penciled in 425. So that's a beat on the bottom line. Q4 revenue, that clocks in at $90.01 billion. That's versus estimates of $87.72 billion. So that's a beat on the top as well. Importantly, Azure and other cloud revenue, ex-FX, 43%. That's better than expected. The consensus called for 39.6% on there. Q4 CapEx, $35.8 billion. The street was at $35.22 billion. So right now, we're basically hugging the flat line here. Importantly, of course, we don't have the forecast. You would expect to get that from CFO Amy Hood on the call. As with all big tech names reporting this season, the focus is going to be on whether Amy Hood gives you some more clarity about what CapEx looks like ahead, 2027 CapEx, what kind of growth, what kind of color we have on that. Expectations were low heading into this print. Remember, this stock was down about 20% year to date. We know the bearish case on Microsoft. There's been worry about the great AI theme and trend, what that could look like for that company's giant enterprise software business. But at least right now, stock is now up about 1.5% initially here in the after hours. Coming up, we'll get an analyst take on these Meta and Microsoft earnings prints. That's next on Market Domination Overtime. Well, for a deep dive now into the latest earnings from big tech, let's welcome in D.A. Davidson, head of technology research, Gil Luria. Gil, my friend, always great to see you. Got a couple big names you cover, Gil, so you are just the man to speak to. Let's start with Meta. It sounds like, Gil, the third quarter revenue forecast, not what the street had hoped, the revenue forecast, that is. Third quarter revenue, they're calling between 61 and 64 billion, Gil. Looks like the midline of that range does miss what maybe your colleagues on the street had called for. They estimated more like 63.2 billion, which I think maybe helps explain the reaction, at least initially here in the after hours. But what do you make of the print, the forecast, Gil? Give us your take.
It's barely passable, right? So they barely met the expectations for this quarter. We still have to sort through the margins and how much one-time expenses matter, because it looks like an earnings miss, but it's unclear how much of that is one-time expenses, taxes, et cetera. We'll sort through that. To your point, the guidance for the next quarter a little light. Some of it may be currency, so we'll have to sort through that. But either way, disappointing. And then the good news is they only slightly increased CapEx, and their cash flow was slightly positive, and I mean slightly. So barely passable.
A big question for the company, Gil, I think a lot of investors have is like, listen, show me the money. Where is the return, Mr. Zuckerberg, on all this historic spend? You have a buy on this name, Gil, so you're a believer. How do you answer that question?
Two parts. One, being good at AI is why Meta is growing 28% in its ad business, which, by the way, is almost twice as much as Google. So Meta is by far the largest share gainer in the ad market, and they are because they use AI to sell more ads and sell them for more. So that's one level of proof that he has. The other one is likely to come on the call when he says, you know what, we have extra capacity in our data centers. We're not using it all. We can turn around and sell it for a very large profit, which will be a windfall because it'll be nearly 100% margins. And I would expect investors to receive that well, that some of this investment at least will bear short-term fruits while they continue to pursue the longer-term goals of being a real player in AI models.
If Zuck does go ahead and sell excess capacity, part of this, let's say a new cloud business, Gil, is that smart financially and strategically? And if they succeed at that, Gil, who is that bad news for?
It's very smart because they're not using all their capacity. They built up all these data centers very quickly, assuming that the Meta models would be competitive and therefore get some of these enormous volumes we're seeing go to Anthropic and OpenAI. They're just not getting it. This is the same thing that happened to SpaceX. They built big data centers, not getting the traction, especially in the consumer, as they thought they would. So there's idle space. So turning around and renting that out month to month is a windfall. And it helps them continue to fund this operation without having to stretch themselves too far in terms of debt and potential equity raises. So the more they do that, the better investors are going to be willing to accept these even higher levels of CapEx.
So let me ask you, I mean, the stock now, we're ticking low. We're down more than 5%. On the call, if you had a chance to ask Zuckerberg a couple questions, what is top of mind for you?
Yeah, when are you going to give up trying to fight Anthropic and OpenAI at their game? There's a lot of room for Meta to be successful in AI, possibly with the leading open source model, again, by selling a lot more ads, selling some of the capacity they have, but continuing to chase what is increasingly a runaway success by Anthropic, OpenAI, and to some extent Google, is not the best use of shareholders' capital, nor is Reality Labs. But that, I think investors have resigned themselves that we're going to continue to lose money there. But at least in AI, there's some ability to either preserve some value or at least turn around and sell extra capacity in order to fund the build out.
You mentioned OpenAI, Anthropic. Zuck right now is on this. He's on a media blitz, is the only way I can put it. He's talking to the New York Times, for example. He's blasting the centralization of AI power, supports more openness. He's going after OpenAI and Anthropic. Why, Gil? What's the point there?
Well, I think everybody's gaining up on, especially on Anthropic, because there's a unique chance. Regulation and policy is being set as we speak, and there's a unique chance to influence that in a manner that favors open source models and not Anthropic models. Anthropic is trying to pull the ladder up.
they did a lot of things without any regulation, without any oversight. And now that they're very successful, they want to pull the ladder up, and they're asking for regulation. They're asking to stifle competition from China, but also just from open source. And everybody else is now stepping up and saying, no, no, no. We want this to be a competitive market. We want open source. We want this to be fluid internationally. We don't want Anthropic to run away with this. So that's coming from Jensen Huang at NVIDIA, from Satya Nadella at Microsoft, and from Mark Zuckerberg and Elon Musk as well.
Gil, let's switch gears. I want to talk about Microsoft, another name you cover. I know another name you like. Looks like the cloud unit, Azure, better than expected. Revenue there increases 43%. Revenue jumps 18% to $90 billion, better than expected. Profit ex some items, 481, better than expected. We don't have, of course, guidance yet. We'd expect to get that on the call, Gil. But what do you make of that print?
This is a really good narrative-changing result. If we had CapEx guidance in the press release, the stock would be up a lot more. Assuming they don't fumble that and just give us reasonable CapEx growth for fiscal 27, this is a very good result. It's a huge beat because Azure is accelerating to 43%. Again, $100 billion business accelerating from 39 to 43%. It's probably going to accelerate for the balance of this calendar year at higher profits, while at the same time, the commercial, the Office products are accelerating as well, because Microsoft has become the orchestration layer through Copilot. So this whole narrative that Microsoft somehow isn't winning is shattered by this result. We just need them to be responsible and reasonable on CapEx guidance, and the stock should do very well.
That narrative, Gil, I mean, listen, heading into this print, stock was down, I think, roughly 20% year to date. I mean, to your point, the bearish case, in simple terms, seemed to be, okay, AI disruption is front and center for Satya Nadella. It's a problem for his giant enterprise software juggernaut. As a bull, a believer, respond to that.
So there's actually two bear cases on Microsoft that they've gotten ensnared in. One is AI is so good that it's going to destroy your software business, and all software is worth zero. We saw that with the SaaS apocalypse, and since Microsoft is the largest component of IGV, they got hit just as bad as all the rest of software. Then there's the other bear case, which is AI is so bad, then why is Microsoft investing so much in it? That investment is now going to bear fruit. So those two bear cases are completely contradictory, and we don't think either one of them is right. We think that 5 years from now, I'm still going to be using Outlook and Teams and PowerPoint and Word and Excel, which means Microsoft's going to do well. Agents will use those tools as well, but so will humans. And then on the investment side, again, Azure is accelerating at higher margins. So clearly this is an investment that's working out. This is the kind of results we needed to see to change those narratives. And again, let's just wait for the CapEx guide.
On that CapEx guide, Gil, let's say on the call, Amy Hood gives you the 2027 CapEx guide. Do you believe is there a sweet spot she could hit, Gil?
That's exactly what we're looking for. We're looking for a sweet spot, let's say between 240 and 280. They're going to finish this fiscal year. They have finished this fiscal year at around 190. Maybe they went up to 200 because of higher input costs. If they guide to something like that, 20 to 30, 35% growth in CapEx for next year, that means that Azure is growing faster than the increase in CapEx. Investors will love to see that. That'll make investors feel like we're at a turning point on cash flow. Cash flow will have bottomed, and then we'll turn up from there. And by the way, compared to Google that had negative cash flow last week, Meta that has basically zero cash flow, Microsoft had probably 20 billion of free cash flow, positive free cash flow in the quarter. So they're in very good shape to continue to invest, but it needs to be responsible. They have to increase CapEx on data centers, but not so much so that it's faster than their Azure growth.
Gil, let's spin ahead to tomorrow, my friend, because you now had two of the cloud giants report. You got Google, you got Microsoft. Tomorrow you got Amazon. Are there read-throughs, Gil, to Amazon and AWS?
Yeah, absolutely. So AWS is going to accelerate very significantly from that 24%. If Google accelerated by 20 points and Microsoft by 4 points, Amazon Web Services is a bigger business, but it should accelerate from that 24%, possibly to 30% or more, which investors are going to love. And then it's going to come back to that question about CapEx, but it's not their fiscal year end, so they can just leave it at hey, you know what? We're going to spend what we thought, which is about $200 billion for this year, maybe more next year. As long as they don't say something like CFO of Google said last week, which is significantly higher capex next year, there should be a relief in Amazon as well. Because again, faster AWS growth and maybe moderating capex growth.
Gil, we are always lucky to have you on the show. Thank you.
Thank you, John.
Coming up, we dive deeper into the broader tech trade. That's next on Asking for a Trend. Hello and welcome to Asking for a Trend. Well, Meta and Microsoft earnings crossing the wire just moments ago. Let's get some more reaction now from Daniel Newman, Futurum CEO, and Patrick Moorhead, founder, CEO, and chief analyst at More Insights and Strategy. Guys, welcome both. Dan, I will start with you. Let's go bigger picture, okay? In that big tech continues to spend, building out their AI dreams. Investors pushing back, right? They want to, you know what, where's the return? Show me the money, they say, Dan. Do you look at these reports we just got and you look at them and say, you know what, yes, those shed light on that question, maybe the biggest question right now for the market?
Yeah, I really think we're at a point where structurally the AI trade is very sound. I think right now we're dealing with a set of pressures, whether it's today, Fed Day, whether it's war in the Middle East, whether it's uncertainty with China, whether it's elections coming up in the fall. I don't think this is what's capitulating AI. I just don't. Having said that, what do you want? Google, 82% growth out of Google Cloud. Azure, beating the number again. Copilot numbers looking really, really good, which by the way is the way they're turning their customers into revenue streams using their AI. Meta, they missed a little bit. I said that was kind of a dual miss that you didn't want to have on a day like today, right? Missing earnings and raising CapEx guide. But I've said this to you before here on this show, the risk of underspending during this AI transformation for companies like Meta and Microsoft is far more existential than the risks of overspending. These companies are willing to see their stock and see their shares sit or move the wrong way for a short period of time because they know what's on the other side. There is gold in those hills.
Patrick, over to you. I want your answer on that same very important question, Patrick. Big tech is spending.
I know that guy.
Investors say, where's the return? Dan brings up a good point. If you're looking for clues in Microsoft, you go right to Azure. Azure just beat. But what's your take on that question, Patrick?
Yeah, so it's all about time frame and your belief in the AI opportunity. I mean, listen, I've been in tech for over 35 years, and I look at, but I've also seen every single hype cycle, what was a hype and what was not, but what actually ended up delivering this. And this is the biggest phenomena of all tech in the history of technology. And if you're looking, for the bumps that might happen in the next year, fine. You're going to get exactly that. But Daniel nailed it. There will be consistent investment, but not from FOMO, but also from how this is going to transform everything. Only 2% of consumers have paid AI accounts, and we're in the industry and we know it. It's been transformational for us. Just wait until the consumers get attached to this in a format that they can consume. You're going to see devices go up on that side. We haven't even scratched the surface on the edge and robotics and what this is going to bring. And then for businesses, there has been a lot of spend in businesses, and we hear about it's not token maxing, token efficiency, but literally they have only changed maybe 5 to 10 workloads if you're a very large enterprise. And they have hundreds and thousands of workloads that they're going to have to move through. So the 5-year build, the 3-year build, I have intense confidence in. Will there be ebbs and flows along the way? Yes, we had a DeepSeek moment. We had a Kimi moment. We had a rate moment today. We had a company with SK Hynix that increased profits 570% year over year.
Not enough.
But there was disappointment just because it didn't hit the consensus estimates that went out. And I will tell you, I have delivered product. Okay, I've delivered PCs, I've delivered servers and chips. When you're in a mega growth market, it's very tough. It's very hard to put some consensus estimates, and you're bound to be wrong in hyper growth.
Dan, there's another school of thought. Get your take on this. Maybe what investors now want is an AI CapEx light model, the Apple model, which we'll hear from tomorrow. It goes like this. Maybe what they're looking, Apple's saying, you know what, just like we did in search, we're going to partner with Google. We're not going to try to do everything ourselves. We'll enable AI monetization at the edge on the phone. Maybe investors like that model. They're not zapping their free cash flow. They're not tapping the debt markets. Maybe that's the way.
Well, first of all, there's only one Apple. So to be very clear, Apple has absolutely gotten away with it. And arguably, they will be the layer where AI is consumed by that 2% and that growing number of consumers that use free services in the, for the foreseeable future, and they will continue to buy iPhones because of it. But Josh, I'll give you another angle that maybe supports your case. By the way, I don't think these things are mutually exclusive. I think it's and, not or. I often say that. But you know what stocks performed pretty well today? Software stocks. ServiceNow was up. You know, other stocks were up today. Palo Alto was up. Security stocks. So AI is actually creating almost this cycle where just a few months ago, AI was going to eat every industry. It was going to eat every software. And now what we're finding out, and I think Palantir CEO Alex Karp talked a lot about, there's an alpha of every business that lives in between the infrastructure and the model. And that's where businesses across industries, hotels, restaurants, manufacturing companies, pharmaceuticals start using AI to enhance their businesses and create great profitability. Yesterday, I was on the West Coast with Mr. Moorhead and myself at the Epic Center, Applied Materials. We sat with their CEO, Gary Dickerson, and he was talking about this being the most formidable trend that will take place in our entire lifetimes, that AI will transform every industry. And what's great with a CEO like that is they're looking a decade into the future at the next generation of materials, of WFE for foundries and fabs. And the reason I point all this out is this is where people like myself and Patrick get this great confidence that this trend is in place. But everything we've heard along the way so far, that industries would be broken, jobs would be displaced, what we're finding is as more time goes on, it's the opposite. Mythos didn't destroy cybersecurity, it created a whole opportunity. CrowdStrike and Palo Alto were up 60 and 75% respectively after Mythos came out. We're seeing now that enterprise software has a role and a place to exist and will continue. And by the way, the point I'm making that supports your point is CapEx-like businesses, software companies, manufacturing companies, pharmaceutical companies. These are companies that are going to use AI, apply it to their businesses, grow productivity, and become more profitable in the long run. So maybe some of the market and some of the dollar flow, some of the flight of capital is going to go to companies like that can prove AI is a productivity builder.
Patrick, switching gears a bit, Microsoft and Meta reported today. You know who else did? Qualcomm. That one, we're down, at least initially in the after hours, Patrick. The profit forecast, not great versus consensus. They're talking component shortages. They're talking rising costs. I'm curious to get your take on that print, Patrick, and maybe more broadly also, what does smartphone growth look like, Patrick, in the quarters ahead, given the memory dynamics we're discussing?
Well, in raw units, it's down significantly. But the key is that Qualcomm operates in the premium handset space that hasn't degraded significantly. It seems to be moving, and that would make sense. This is a transition quarter for Qualcomm. Apple is dialing down quicker. Data center hasn't hit yet, but it is going to hit significantly very, very soon. And then you have this rocking automotive business, which is this industrial IoT, this industrial edge and AI capability that I talk about. The great news is and their CFO was very clear, the China trough, we are out of it, right? We're coming up. So it's really on the smartphone side, it's all up from here with a very competitive product line in Android. I mean, just to be clear, Qualcomm owns premium Android, and while it's easy in the US with Apple having 60% market share, the rest of the world, for the most part, is an Android world. What I'm really excited about, though, is watching the data center play that was literally at zero 3 months ago with the sell side and the buy side folks, and now it's going to be a very significant business. Multiple flavors of data center CPUs, multiple accelerators, and not just a Me-Too product. A new technology called HPC, which is different from what NVIDIA is doing. It's different from what AMD is doing, and even accelerators like the Google TPU.
Final question, Dan, to you, since we're talking Qualcomm. Just on the chips more broadly, the sell-off there has been ferocious, right? And maybe, listen, it doesn't take a hedge fund genius to say you would see some steam come out after just parabolic moves. But what stops the chips from falling at this point?
Well, I mean, I think you've got capitulation, which we've seen today in some ways. I mean, I think you have to get back to fundamentals, right? When the entire market is not working. I mean, at least when it's working from a standpoint of it's being efficient right now, and it's working, and flight of capital and risk is going out of the market, out of these names and into other names. But you have to get back to looking at fundamentals. You know, we've got a bull case of $11.7 trillion of CapEx between now and 2030. You look at names like NVIDIA, and you would say, what's broken there? Is this a broken stock or a broken company? And I think right now what you have is a lot of names in the semiconductor space that are broken stocks, not broken companies. They're delivering great growth, record growth. But people get caught up in things. They look at things like net revenue dollars versus the size of the market and growth. And then they'll look at things like how much market share they have, like NVIDIA having 97, 98% GP. Oh, AMD is going to come in. Maybe they're going to take a couple percent of market share. Should we sell that? I don't know. They're going to generate hundreds of billions of dollars of free cash flow. So you got one side of the market saying, oh, we're mad at you for spending cash and capital and burning free cash flow. The other side, you have a company creating immense free cash flow, and people aren't buying that either. At some point, I think, as you said, the air comes out of the balloon. I think the market is taking a breather here. The long term is very, very sound for the AI trade. The short term, though, it's a lot of external factors. And that's why I'm weighing this in. Is anyone that's looking at the earnings of these AI companies, it's very hard to look at a Micron and be like, those weren't great earnings. Those were great earnings. But having said that, when macro, when interest, when inflation, new Fed chair, questions about China, questions about the Middle East, oil's rising, when all those things are happening, can a market function in a way that can support a bullish growth? I think over 5 years it'll be yes. I think over the next several months, it's going to be touch and go.
All right, Dan, Patrick, as always, great to have both you guys on the show. Appreciate it.
Thanks, Josh.
Coming up, we have earnings from Starbucks and Chipotle. That's next on Asking for a Trade. Chipotle and Starbucks earnings, they're just crossing the wire. Here to break down both reports for us. We've got Yahoo Finance. Brooke DePalma. Brooke, let's start with Starbucks first.
All right, well, let me just point out that tech companies might be down, but both Starbucks and Chipotle moving higher in after-hours trading. They certainly outperformed expectations. Let's start with Starbucks. This was the fourth straight quarter of global same-store sales growth for Starbucks. And yet again, in North America, they outperformed expectations. What largely is driving this is higher transactions, aka people are going to Starbucks more, and when they do, they're spending more. We know that Brian Niccol has really been leading the helm of a turnaround strategy there. And so what's working for them are refreshers and other more expensive drink. Even me and you have talked on set about people adding more foams and flavors, and all that costs more. And that's driving prices higher, or rather how much customers are paying up at Starbucks. And certainly it's working for the company. And now the call is currently underway. And the company actually also raised their guidance for 2026. I do want to get to that because they said with 1 quarter left in the year, they expect fourth quarter same-store sales growth in the U.S. to be up 6.5% or better. They also said that overall they're raising their U.S. same-store sales growth of a little more than 6% and global sales growth nearing 6% for the full year. So they really do expect this momentum to continue, and that's why you're seeing the stock move higher in after hours.
The stock was already up about 20% year to date heading into this print. Now you're tacking on about 7% in the after hours. But you look at this print, Brooke, and you say, okay, this is CEO Brian Niccol. You see his turnaround plan strategy fingerprints all over this.
Fingerprints all over this. And what's so interesting is that this is now the third year of that back to Starbucks plan that Brian Niccol, when he joined the helm back in 2024, this was around the time that he joined. And so to see this growth, this turnaround still hold on has been really interesting. I also want to point out that they actually saw revenue decrease year over year. And that's because of that sale of to a joint venture within China. So keep a lookout for that. But also, Josh, I don't know if you've been to your local Starbucks lately, but they added back all the seats, all the tables, and that's actually driving growth too. And so that back to Starbucks plan, that return of that cozy vibe for Starbucks really seems to be working for them. They had a goal that they were going to uplift 1,000 stores in North America, and they actually already surpassed that goal. And so it seems like firing on all cylinders, I guess you could say. A little jargon there. But
what about Chipotle? Talk us through that one.
All right, well, Chipotle, also a good quarter there. The company saw same-store sales grow less than Starbucks, but still up about 2.2%. That was more than what Wall Street had expected. The company also did raise its guidance there. So what we did see there was it now expects same-store sales growth for 2026 to be in the low single-digit range. Prior to this quarter, they had expected sales to be flat for the quarter. Now that call also underway, but what we have heard so far is that these higher same-store sales growth was driven by, yet again, a higher average check size and higher transactions. And Josh, I know you're a fan of honey chicken.
Oh, yeah.
That was one of the drivers this quarter.
Well, I was going to ask you, what are the products they're calling out?
Yeah, so they're calling out the honey chicken. They're also calling out an update on their marketing strategy, on their menu innovation, their loyalty program. So they said all of that, it's part of what they're calling this recipe for growth strategy, and that's contributing to higher sales. Now, I'm curious, as we're listening to the call, what exactly they saw among consumer groups, because heading into this print, there was some fear that because of higher gas prices, higher energy prices, that the lower income consumer would be under pressure. And we haven't heard just anything just yet, but it's interesting to see this company outperform. Keep in mind, these companies are both lapsing some, previous last year 4% decline in the second quarter for Chipotle. So lapsing some declines as well. Important to note there.
All right. Thank you, Brooke. Appreciate it. Well, Robinhood shares edging lower after earnings despite topping Wall Street's estimates and reporting a double-digit revenue gain. The mobile trading platform seeing higher activity spurred by market volatility. Still, crypto has weighed on that company this year, with Bitcoin down nearly 50% in the last 12 months. Shares of Robinhood have struggled as well, down about 20% year to date. Shares of ARM Holdings, they're under pressure. That company, that's coming after the chip designer reported quarterly earnings that did top analyst estimates. Investors seemingly underwhelmed, though, by the company's outlook, while concerns remain around smartphone demand. One bright spot was data center, where royalties more than doubled and demand for ARM's new AI chip continues to build. And lastly, Carvana stock, that's sinking after hours, trading following its second quarter results. The online auto retailer reporting better than expected revenue for the quarter, as adjusted EBITDA only came in slightly above expectations. While looking ahead, the company's guidance for full year adjusted EBITDA did disappoint the street. Stick around, much more for a trend that's still to come. Time now for To Watch, Thursday, July 30th. It is another huge day for markets with earnings from two more Magnificent Seven companies after the markets close, plus a couple of high-profile debuts hitting Wall Street. Starting off on Apple, investors will be listening carefully to CEO Tim Cook's final earnings call before he steps down on September 1st. Analysts expecting iPhone demand to remain strong in Q3, which could help lift global sales. Alongside Apple, Amazon also reporting quarterly results with the big focus on Amazon Web Services. Investors waiting to see whether AWS growth is reaccelerating as demand for AI computing continues to surge. Capital spending also in focus as Amazon continues pouring billions into data centers and AI infrastructure. A couple companies starting their stock journey. Sandwich chain Jersey Mike's is set to make its public debut on the New York Stock Exchange, and the ticker JMKE is coming after almost 2 years of rapid expansion under private equity owner Blackstone. Also expected to begin trading as fashion brand Reformation. That IPO drawing some more attention as investors look for signs the market for new listings is continuing to reopen. That's a wrap on today's show. Thanks for watching.